Inheritance tax, IHT, isn't a very popular thing. In fact, it's often named Britain's most hated tax. The idea of working all of your life to give a big chunk back to the Chancellor after you've gone sticks in some people's teeth. The problem is, though, there's not a magic wand you can wave to avoid it. There are things that you can do, but quite often they involve gifting money or using trusts, which essentially means losing access to capital. Certainly not ideal when your main focus is on enjoying your own retirement lifestyle. Now, pensions are fantastic tools for passing on assets without the deduction of inheritance tax, but it's difficult to add much into pensions in the latter years of your life when the IHT problem really starts to build. There are other strategies, but usually those other strategies carry higher investment risk. Or there might be strategies that could be contentious in the eyes of HMRC and potentially challenged as tax avoidance schemes. So what can you do to solve your IHT problem that doesn't require you giving away large sums of capital, doesn't require you taking high investment risk, and will never be challenged by HMRC as a tax avoidance strategy? Well, stay tuned and I'll explain. I think you're going to like this.
Not a lot, but you're going to like it.
As always, there are timestamps in the description below. I'll describe the basics first and I'll give you a real example of an inheritance tax strategy at the end so you can understand how to apply it to your own situation. If you like these types of financial planning videos, be sure to subscribe and hit that notification bell if you haven't already, and let's get into it. Now, if I was to tell you that there was a plan you could use that essentially allows you to save every month to mitigate your inheritance tax bill, and that could guarantee to eliminate it immediately if you died tomorrow, you'd probably think I was making it up. But actually, there is exactly such a plan.
What? No way!
I've personally used this strategy with numerous clients over the years, and I have to say that it is, and probably always will be, the simplest way of dealing with an IHT liability. So if that's the case, why doesn't everybody do it? Well, I think it's because of how people perceive this plan, or more importantly, how they perceive its cost. You see, it's not called an inheritance tax savings plan. It's called a guaranteed whole of life assurance policy. Most people are used to paying insurance from pretty much the time they reach adulthood, with their car usually being the first thing of significant value that they need to insure. They then often get used to paying life insurance premiums to protect their mortgage and maybe critical illness and income protection premiums too. These are what are called term assurance policies, which just means that they'll pay out only if the event you've insured against occurs within a specified time frame, and all share a key thing in common. You hope you never need them. If you live a life without having to claim on your term assurance policy, it's clearly a good thing, but you don't get anything back when the policy expires, and for that reason, people see all types of insurance as a cost, regardless of what type of insurance it is. That's why it's important to understand the difference between life insurance and life assurance. They might sound similar, but they're different. You insure against something that might happen, but you assure against something that will happen. You might have a bump in your car, but it's not guaranteed. So that's a risk you insure against. You might suffer a critical illness during the term of your mortgage, so you insure against that risk too, just in case. Whole of life policies, though, are different to term plans. They remain in force for, well, the whole of your life. And we can all be certain that at some point, sadly, we will depart this mortal coil. Therefore, a whole of life policy is a form of life assurance. It will pay out at some point. With that being the case, I often ask my clients not to think of whole of life assurance policies in the same way as they would life cover on their mortgage. I encourage people to think of them as guaranteed savings plans, because if you think about it, that's what they are. Once an application is accepted for a whole of life policy and the insurer has assumed risk, as long as you maintain the monthly payments, a lump sum payout is guaranteed. It's far better than a savings plan in my opinion though, because the sum assured is guaranteed from day one. Let's say you set up a normal savings plan and decided to pay in £500 a month. If you died after 1 month, you'd have saved £500. If you had a whole of life assurance policy though, with a sum assured of £250,000 and a monthly premium of £500, if you died after 1 month, you'd have £250,000, or your beneficiaries would, to be more precise. That's quite a difference. How long do you think it would take to reach £250,000 if you were just saving £500 a month? The answer is quite a long time, but I'll demonstrate that with a real example later. So how do these plans actually help with IHT then? You might be thinking surely having a big chunk of cash paid to me on death will make my IHT problem worse, not better. Well, that could be true, and that's why the right type of policy needs to be set up in the right way. First though, how do you use these plans and who are they for? Well, to begin with, you need to work out what your tax liability is. So to give an example, we'll assume that you've already done as much other inheritance tax planning as possible, or as much as you want to, through gifts and other vehicles, and you're not planning on leaving a sizable part of your estate to charity, which can actually reduce the IHT rate that you pay. We'll also assume that you're married and you both qualify for the full nil rate band and the main residence nil rate band, which are the main allowances that are offset against the value of your estate. So a bit like the personal allowance for income, the first part of what you own isn't subject to any tax on death. Some people may have no IHT to pay at all if their estate isn't big enough. The nil rate band is currently £325,000 per person, and the main residence nil rate band, which can be offset against the value of your main home, is £175,000. A note on this though, the residence band is only available if you're leaving your house to lineal descendants, such as children or grandchildren, and you start to lose it when your estate exceeds £2 million. We'll say that you have wills, and the wills simply state that when one of you dies, everything you own passes to the surviving spouse, and then when they die, everything is split equally among your children. So in this situation, there'd be no inheritance tax payable on first death. Everything would pass across to the survivor free of tax, and they'd also inherit the deceased's nil rate band and main residence nil rate band. So then if we assumed the taxable estate was worth £2 million, there'd be some IHT due on second death. The taxable estate is everything you own that isn't exempt or subject to relief. Pensions, for example, are exempt, so you wouldn't include those. The combined nil rate bands add up to £1 million, so there'd be no tax on that part. The remaining £1 million would be subject to 40% tax though, which means your beneficiaries would be left with a tax bill of £400,000. If you therefore took out a whole of life policy with a sum assured of £400,000 to pay out on second death, the plan would fully cover the tax bill. It needs to be placed in trust with your children as beneficiaries though, otherwise the payment will come straight back into your estate, meaning the tax bill would be even worse. The trust ensures that the sum assured can be paid straight to your beneficiaries without delay and without having to wait for probate. They then have the money they need to pay the tax bill without having to sell or use any of the assets you leave behind. Now the reason that this is the most bulletproof inheritance tax strategy that exists is because the tax isn't actually avoided. You've just put a plan in place to make sure that it's paid rather than having to use your other hard-earned wealth. HMRC couldn't care less how they get paid. They just want their money. So this approach will never be challenged. So that's the principle, but it's also important to choose the right type of whole of life policy, because there are essentially two. There's a reviewable premium option and a guaranteed premium option. I'm quite resolute about this though. I only think guaranteed whole of life policies are worthwhile for most inheritance tax planning. A reviewable premium policy will invariably start off much cheaper because the premium is based upon the chance of you dying generally within the next 10 years. If you're 60 and healthy, the chance of that is still quite low. However, when you get to 70, the premium is reviewed again based on the next 10 years risk, which is considerably higher. And by the time you get to 80, the risk is then very high, which means that the premium will probably skyrocket. I've seen people take out these policies in the past and then end up cancelling them because the payment becomes unaffordable, and they've then wasted all of their money. A guaranteed premium policy though will start off higher, but the payment will never change unless you decide to increase it annually with inflation, which increases the cover amount as well. This is why it can be worth considering earlier in retirement, because the younger you are, the lower the cost, and also you may have better health on your side. That's a very important consideration because, like most types of insurance, you being a poor risk, i.e. having poor health, will mean the cost is much higher, or cover might not be available at all. The longer you leave it, the higher the chance there is of that happening. If we look at an actual example of cost then, let's say you're a male aged 60 and you need £250,000 on a single life basis. Joint life second death policies are usually less expensive, by the way, because 2 people have to die before they pay out. But we'll base this example on a single life. As a non-smoker, on a guaranteed basis, the monthly payment, which was correct in February 2022, would be £538.47. That quote was provided by Royal London. Now, if you're thinking £500 a month, I couldn't spend that. Remember to think of this as a savings plan. We'll come back to whether it's good value in a second. Once the plan is in place, it's guaranteed to pay out £250,000 as long as those payments are maintained. So if we consider for a moment what your average life expectancy would be, as a healthy 60-year-old male, it's currently aged 82. That means that if you lived to the normal life expectancy age, you'd have paid in £142,156, and getting a payout of £250,000 is equivalent to receiving a 4.8% annual net return. Remember though that if you died at any point before that, the guaranteed return would be higher because you'd have paid in less. Could you achieve a better return? Yes, it's possible, but not without risk. Even to get a net return of 4.8%, you'd have to accept a reasonable degree of risk. And that means that the value of your plan would be variable and might be nowhere near what you need when you need it. As well as that, a regular investment plan would accrue in the deceased's estate and would actually make the tax problem worse. If there's already an IHT liability, 40% of the investment plan would also be lost to tax. So I think guaranteed whole of life assurance does 3 things. It gives certainty of cost, certainty of access via use of a trust, and certainty of outcome. I think those 3 things add up to peace of mind. I always say though that there is no perfect solution to everything. It's usually best to combine a variety of strategies to get the best result. Quite often I use tax-efficient investment vehicles with the use of appropriate trusts for my clients to generate the income to pay for these policies, which works very well. As I said at the start, pensions can be fantastic vehicles to help avoid IHT. So watch this video next to understand some of the big taxation issues that affect pensions and the big mistakes that a lot of people make. If you watch that video, you'll know how to avoid those common mistakes. I hope that's been useful, guys, and I'll see you next time.